Good morning, everyone. Thank you for joining us. My name is Brent Ledbetter. I'm a product specialist at Research Affiliates focusing on our equity strategies. At Research Affiliates, our mission is to be the preeminent source of products and insights for the benefit of investors. In accordance with that mission, we published a series of papers last year in which we warned investors that smart beta can go horribly wrong if used to chase performance. Instead, we urged clients to pay attention to valuations by looking before they leap and asking if the price is right. We added to this research earlier this year via an article titled A Smoother Path to Outperformance with MultiFactor Smart Beta Investing. While difficult to say in a lengthy title, this has been one of our more popular articles. Given the intention this piece has garnered, we thought it would make for an excellent topic for a deeper dive on today's webinar. A couple of quick logistical notes before we get started. The audience is in listen-only mode. All lines are muted. However, while your lines may not be live, we plan to use the majority of our time today answering your questions. Please submit any questions you have in the dialog box on the right-hand side of your screen. We will answer as many as possible on the call. Additionally, a member of our team is going to follow up with every question after this call. We value your feedback and questions, so please feel free to liberally submit any comments and questions you have as we go. Well, that's enough for me. Without further ado, I'm pleased to introduce the star of today's webinar, Chris Brightman. He's not only a co-author of the research we'll be covering, but he's also our CIO here at Research Affiliates. Chris, over to you.
Thanks, Brent. Today, we're going to cover 3 key points. We're going to talk about what a factor is and which factors are important for investing. We'll talk about some of the pitfalls of using factor strategies, and then explain how a multi-factor portfolio can be successfully used to create the opportunity for persistent future outperformance. Now let's talk about what a factor is and which factors are robust. For purposes of today's discussion, I'm going to refer to a factor as a characteristic of a stock that predicts future outperformance and excess return. Academics have identified hundreds of factors or characteristics of stocks that purportedly do forecast future excess returns. It's not plausible, however, that there are really hundreds and hundreds of independent factors, all of which are reliably going to predict future outperformance. Rather, leading academics and thoughtful practitioners have identified a handful, perhaps a half dozen key factors that you can have confidence will provide the future opportunity to outperform the market. Let's take a minute to talk about these key factors. The first 2 are familiar and they're price-based: momentum and value. Over the short run, if a stock's price has been outperforming the rest of the market over the past few days, weeks, months, quarters, empirical research strongly indicates that that stock is a little more likely than not to continue to outperform the market over the next few weeks, months, quarters. However, over longer term periods, we see mean reversion. If a stock's been outperforming the market for the past few years, it's more likely than not to underperform over the next few years. That's the value effect. Short-term positive serial correlation, long-term negative serial correlation, momentum, and value. The next factor that I'll draw your attention to is a risk-based factor. This also is related to prices. Instead of looking at the level of prices changes, we're now looking at the volatility. We can call this a factor low volatility, low beta. Essentially, the low beta factor refutes the predictions of the capital asset pricing model. Many of us were taught in our business school or our investment classes the theory of the capital asset pricing model, that higher risk, higher beta stocks should provide higher returns. And if you're going to invest in lower risk or lower beta stocks, you're going to have to accept lower returns. The evidence is completely contrary to the predictions of that model. In fact, at first blush, you should just assume that equities provide about the same return, whether or not they are high beta, low beta, high volatility, low volatility. This is a very nice property which can allow us to form portfolios that can outperform the market without higher volatility or even lower volatility. The next factors are more recent in discovery and rather fascinating because they predict persistent future excess returns without any reference to price. Kind of surprising when you think about it. You can know nothing about the price of a stock. You just can understand the characteristics of the company that issues the stock, and it predicts outperformance. We use a combination of profitability and investment to define quality. Quality can mean many things to many people, but the most robust definition of quality that comes from sound academic research is focusing on profitability and investment. These are the two factors that Fama and French have recently added to their multi-factor model. And let me explain briefly how we put this together. Profitability, whether you define that as return on assets or return on equity, is rather obviously a characteristic that we would look for in a company we want to be invested in. However, profitability alone doesn't really seem to predict future excess returns. Everybody understands that they want profitable companies. The prices reflect that. However, if you pair profitability with conservative investment, think in Graham and Dodd terms or in Buffett and Munger terms of a company that has a reason for existing, an economic mode, it has strong profitability. What you want to pair with that is a management team that's investing wisely, conservative investment. That is how we define quality, profitability plus conservative investment. These are the factors that, as I said earlier, you can have some confidence will predict future positive excess returns. However, you can use factors and smart beta strategies designed to access these factors in a way that hurts your returns instead of improves your returns. And it's not just that you can do this, but many, many investors actually do. So let's look at the evidence of the misuse of factors. Trend chasing is everywhere. Academics are data mining, looking for the best historical performance. Investors are chasing the strategies and factors that have provided the best performance looking backwards. And of course, practitioners develop products and market those products to investors based upon the past recent performance. And this hurts returns. First, let's look at what comes out of the academy. We show here the excess return documented by these careful and thoughtful academic studies, and then the returns provided by the factor after publication. We can see Value was providing a 10% per year average excess return when it was published, and since publication has dropped down to a 2% excess return. Now, 2% is not bad, but it's certainly nowhere near the 10% that was observed prior to publication. Let's look at size. 7% before publication, less than 1% after publication. Low beta, 7% before publication, 2% after publication. The average of all of these factors was 6% before publication and just a little better than 2% after publication. So there was excess return, but not nearly as large as when these factors had been identified. Investors are even worse. We show here the time-weighted returns on the green bars of all mutual funds, and then mutual funds broken down into some familiar categories: growth funds, value funds, small cap funds, large cap funds. Note that all funds in general tend to provide returns before fees that just about equal the market return. Market return here, just about 9%. The average of all the funds, 8.8%. Just about market level returns. However, the investors in those funds didn't get that 8.8% return. The investors did 2 percentage points worse. Why did investors get lower returns than the funds? It's not fees and expenses. This is all before fees and expenses. Investors have poor timing. They get into funds after they've done well for a period of 2, 3, 5 years. And then, predictably, there's mean reversion, and the funds don't do as well after somebody's gotten in. And so they sell them, going and looking for another fund that's outperformed. Exactly the wrong behavior. You can see that this performance-chasing destruction of value is greater for growth funds than it is for all funds. And it's not quite as bad for value funds, but look at what we see among the value and the small cap funds. Just as predicted by factor models for decades, value funds and small cap funds do outperform the market. They have outperformed the market, but the investors in these funds, through performance chasing, have failed to beat the market. Now let's look at a little more complicated analysis of ETF launches. We display here on the vertical axis the cumulative excess return of the indices that ETF providers choose to launch an ETF on. And then we show the dotted line, which represents the time that the ETF vendor files with the SEC, registers with the SEC to launch an ETF. And then we show the performance of the ETFs subsequent to launch. Notice that there is a persistent and large outperformance on average and over the full range of indices before launch. And then 6 months before launch, the point at which you have to register with the SEC, the index you're going to use, it goes flatline. There's no outperformance of these indices on average after launch. Now, it may seem at first blush that there's something about the process of registering the ETF with the SEC and launching an ETF that causes the index to stop outperforming. But that's not really what's going on, of course. It's that if we had plotted the average return of all of the indices that an ETF vendor might have chosen to launch an index, it would have been average return, flatline, just like subsequent returns. But of course, the index providers don't choose randomly which index to launch. They ask investors, they ask salespeople, they ask the marketing departments, what do investors want to invest in? And of course, what we know is investors want to invest in those regions, styles, strategies, factors that have been doing well over the past 2, 3, 5, 10 years. That's what the press pays attention to. That's what people are excited about. That's what investors want to invest in. So that's what product providers develop and sell. And it's that process of choosing the past outperformers that causes this problem of no outperformance after launch, despite the wonderful performance prior to launch. Smart beta strategies do a little better, but there's still performance chasing. We show here the discovery of the smart beta strategy, whether that's a fundamental index, a low vol, even dividends, as well as more complicated strategies like risk efficient and maximum diversification. On average, these strategies provided returns of 1.8% prior to launch, and after launch, they've provided an average return of 1.4. Now, that's a far better record than the academics and infinitely better than the record of individual investors who destroy their returns through performance chasing. But still, the difference is material. You should take with a grain of salt all of these back tests. Well, hopefully we've provided you with a clear indication of how not to use factor-based strategies through performance chasing. Now let's spend some time talking about how you can use factors to create the opportunity for persistent excess returns looking forward. To create a multi-factor strategy, you need to answer two questions. Which factors should you include, and how should you manage those allocations through time? We've already discussed the half dozen factors that we think provide an opportunity for robust future excess returns. The price factors momentum and value, low volatility. The two factors that together form quality, profitability and conservative investment. And lastly, size. Now, how should we manage these half dozen factors through time? In order to shed some light on this question, we conducted an intuitive study. We started with the simplest approach possible, which is just equal weight those allocations at inception and then never rebalance or change those allocations through time. The second simple and obvious alternative was systematic rebalancing. Every year, you return all of the weights of those factors back to equal allocations. Lastly, and a little more complex, we created a dynamic allocation that overweights the cheaper factors and underweights the more expensive factors, looking to add return beyond simple systematic rebalancing. Let's look at the results. Over this period of time, U.S. stock market return was about 11%. If we look at smart beta strategies designed to access these six factors, the average return of those factor portfolios was 13%. Not surprisingly, a buy and hold combination of those factor strategies provided you the same return, a little over 13%. And systematic rebalancing didn't do much better, 13.5%. However, if we dynamically rebalance, favoring those strategies that we have higher future expected returns, we end up with a 14% return, a 14.2% return, a 70 basis point improvement over buy and hold and systematic rebalancing. And this did not come with additional risk. Look at the increase in Sharpe ratio. The market provided a 0.4 Sharpe ratio. The average factor buy and hold systematic rebalancing is 0.5, 0.6, 0.5.5. And the dynamic rebalancing gets you up to a 0.6 Sharpe ratio. And the information ratio looks fabulous as well. Obviously, the market has no information ratio. The average information ratio of the six factors is 0.3. And because these factors are diversifying, their correlations are not high, and sometimes even negative, blending the factors into a multi-factor portfolio provides a much better information ratio, 0.6, and dynamic rebalancing takes you up to a near 0.8 information ratio. Let's take a look at this in graphical terms. We show here the value add, the excess return over the market on the vertical axis, and tracking error on the horizontal axis. We can see there's a variety of plot points for our factor strategies, from size, providing a return premium, a value add of a little over 3%, but at very high tracking error of 10%. Profitability, providing not much of any value add at all, but nicely diversifying other strategies like investment and value. If you combine these all together, the portfolio moves up and to the left. The buy and hold and the static rebalancing portfolio have better than 2% excess returns with less than 4% tracking error. And if we use dynamic rebalancing, we take that return up to above a 3% excess return, still staying around a 4% tracking error. This truly is a wonderful opportunity for investors to pursue persistent future excess returns.
Well, Chris, thanks for that overview. I think that at a basic intuitive level, we're all mindful of the dangers of chasing winners, but the research you and the team have done really shines a light on just how costly performance chasing can be, as well as the potential excess returns that are possible when you adopt the opposite approach, the opposite of performance chasing by the losers instead of the winners. A quick note for anyone interested in learning more about our smart beta and factor research: a replay of a webinar we recorded in March with the ever so subtle title of "Forecasting Smart Beta and Factors: History is Worse Than Useless" is currently available on our website. As is a smart beta interactive tool on which you can see historical returns, correlations, along with metrics such as our trading cost estimates, forecasted returns, and frankly, considerably more information for a vast array of strategies, including many of the portfolios that Chris covered this morning. But enough from me. I said we could get to as many questions as possible. So with that, Chris, first question we have is, RA's produced research in the past that suggests quality, size, and momentum are not robust sources of excess return when applied in an index wrapper. But now we're incorporating them in our multi-factor strategy. How do you reconcile that?
That's a great question. Let's take them individually. Momentum, quality, and size. Now, momentum in a backtest, in a simulation that assumes you can trade with no transaction cost at infinite size, is perhaps the most robust, strongest performing factor you're ever going to find. The problem with momentum, of course, is that it's most apparent for the smallest, least liquid stocks, and it completely disappears as soon as you go and try to trade. We've studied all of the mutual funds that have the word momentum in them, and we can't find any of them that have provided long-term excess return. So fabulous back tests, very disappointing live performance. Perhaps the best way to use momentum is to not trade. If you use momentum to block trades that you otherwise might have done, if a stock has been performing wonderfully well and has gotten expensive as a candidate to leave the portfolio, but has strong positive momentum, it doesn't cost you anything to wait a quarter or two to sell that position until the momentum is dissipated. Or if a stock is looking cheap and a great addition to the portfolio, but it has strong negative momentum, it costs you nothing to wait a quarter or two before you buy that position. That's the way to use momentum. Now, quality, often in the literature defined as profitability, does not by itself seem to provide a future excess return. However, because the correlation of the difference in return between a quality portfolio and the market, its excess return, is negative relative to the excess return of other factors like value and conservative investment, it greatly improves the overall performance of a multi-factor portfolio, even though it doesn't provide a persistent excess return on its own. Lastly, size. Now, if you look at size, defining the size of a company as its market price, as its market capitalization, you do find that smaller companies have higher returns than larger companies. However, interestingly, if you define size any other way, if you define size by the amount of assets a company has, or the book value the company has, or the number of employees that the company has, there is not any higher returns for small companies than large companies. The reason for this counterintuitive finding is that if you use market capitalization to measure the size of the company, you're not just measuring the size and scale of the operation, you're co-measuring its size of the company and the price of the stock. Low-priced stocks have higher returns than high-priced stocks. So it's just reintroducing the value factor. Does that mean that we should discount the size factor? No, not at all, because smaller companies are less efficiently priced than larger companies. If you're going to employ a factor strategy like value, like momentum, like quality, like low volatility, you might have better results in smaller companies. Now, you have to be concerned about transaction cost, limited capacity, etc. But nonetheless, there's a wonderful opportunity to deploy the other factors within the small space.
Great. A related question to those factors we've selected. We had another question that came in and said some multi-factor strategies use 3 factors, others use 4. Yours uses 5. What's the appropriate number? How do I go about evaluating these strategies? I think the question is, should the number of factors be an important decision point for advisors as they're choosing across options?
Some of this is semantic, and I don't think that there's ever going to be consensus on the precise right number of factors. More important than the number is choosing logical and robust factors. Again, momentum and value, quality, properly defined, volatility, and size, if you think about size as being a proxy for a less efficient opportunity set. We've chosen to combine profitability and conservative investment to create what investors are looking for in terms of a quality portfolio. There's no reason you couldn't use profitability and investment independently. There's no right answer to that. There are some investors who look at the evidence on momentum and think that the implementation costs suggest that it's just not worth trying to chase that factor. That's a perfectly reasonable conclusion. So there's no right answer to which factors, but having an informed understanding of which factors have in the past reliably predicted future excess returns, and why I think helps an investor create a more informed decision when evaluating multi-factor strategies.
Next question, a little bit more granular. I think the person that asked this question is pretty familiar with with the methodology that we're using in our multi-factor indices. Specifically, he or she asked, why do we use reversal instead of valuation multiples as our indicator of value when determining the weights of our factor portfolios?
Mean reversion and value, of course, are very closely related. And theoretically, we prefer a fundamental valuation metric, like a combination of price to book and price to earnings and price to sales, etc. However, that can be problematic when applied to factors. Take a factor like momentum that's very high turnover. If we're looking at the valuation of the momentum factor today versus the valuation of the momentum factor a year or two ago, those PE multiples and price to book multiples from a year or two ago might be completely different companies than the companies that comprise the factor today. Conversely, you could look at the same companies today that are in your factor portfolio. What was their valuations a couple of years ago? But they weren't positive momentum stocks then. It's quite difficult to figure out what the right way theoretically and practically would be to measure valuation of a factor portfolio. Using simple long-term mean reversion produces results that are very, very similar, maybe even superior to valuation ratios, and is just easier to interpret.
Sticking with that theme of the weighting of the portfolios, we got several questions on trading costs. So I'll just sort of combine these into one. How much does the dynamic weighting of the factor portfolios increase trading costs relative to the static approach, so just the systematic rebalancing that you outlined?
Trading costs can never be estimated without an assumption of assets invested. If our product or your product or any investor's investment strategy is the only one pursuing a particular strategy, you're likely to have very modest implementation costs. However, that's not what's relevant. What's relevant is how many other people are doing the same thing and doing the same thing at the same time. There's no simple answer to this. The reason we are focused on value-oriented strategies and mean reversion is we are confident that it's the largest and most persistent opportunity in the capital markets because it's so difficult to do. You're providing liquidity instead of taking liquidity. You're selling to the market what the market wants to buy, and you're buying from the market what it wants to sell when it sells it. If you are rotating into value stocks, whether those are global resource companies a couple of years ago or financial stocks in 2009, you're not going to have any market impact. You're going to be able to buy all of those stocks that you want. On the other hand, if you're momentum investing, you're going to have much more trouble with market impact.
Great. And I'll use this as an excuse to throw in another very blatant plug for our Smart Beta Interactive website, as we have capacity and trading cost estimates on that page. So again, the Smart Beta Interactive website on researchaffiliates.com. That's my blatant plug for more information on trading costs. Next question, in a little bit different direction. Next question is, in which environments would a multi-factor strategy underperform?
It's much easier to answer the question, in what environment are each of the individual factors going to outperform or underperform. Of course, momentum is going to underperform when there's reversals. Value is going to underperform when there are multi-year momentum markets. Quality is going to underperform most strongly when you have a turn in the market that favors the lower quality stocks, which often accompanies an economic rebound. When we look at these multi-factor portfolios going backwards, they look like they provide wonderfully consistent excess returns. And of course, that's too good to be true. There will be periods in the future where your multi-factor portfolio is going to be horribly disappointing. That's almost a certainty. And the worst thing you can do is bail out when that happens. What we know is that the future will be different than the past. And as assets pour into a new strategy of this sort, the dynamics will change, and you will see in the future returns and the future performance disappointing results that are not apparent from the past simulation. Know that going in, and don't bail out.
Similar to the to your final comments on the performance chasing or the performance changing as assets are gathered, we got a question along the lines of, as these multi-factor strategies gain popularity and attention and assets, do we have a concern that the value add from these factors that have been identified? Do we have a concern that the value add will be arbitraged away as money flows into these strategies?
Yes, of course. Look, we would like to believe that there are half a dozen factors that exist as forces of nature, that all you need to do is create exposure to that factor and you're guaranteed future positive excess returns. And that better yet, these factors have negative covariance of excess returns with each other. And because that negative covariance will continue and the positive excess returns will be there forever, all of the world's largest investors can create multi-factor portfolios that will provide to them consistent 3.5% excess returns forevermore. We'll all be able to outperform the market by 3.5% a year forever. Now, that is obviously too good to be true. It's not going to happen. My expectation is that the multi-factor becomes popular for a while, disappoints for reasons that nobody will be able to forecast ahead of time. There will be large outflows from these multi-factor strategies at that point in time. Those individuals that have the conviction to stick with it will probably get good returns over the longer horizon. Those people who have the true contrarian ability to get in after a period of underperformance will do even better. But this is not a magic strategy. It's the same as all other strategies. It will perhaps outperform over the long run, but won't do so every year.
I'm going to change gears a little bit. We've got a question gets a little bit into the weeds. Got a question on the integration versus mixing topic that we hear frequently. Essentially, the question is why combine independent factor portfolios instead of offering an integrated approach? So if you could first maybe define what those two options are, talk about what an integrated approach is versus what the mixed approach we've outlined today. And then if you could talk about the benefits of both approaches.
Sure. So to explain, mixing has come to mean creating a half a dozen independent factor portfolios where the value portfolio just is looking for cheap stocks. The quality portfolio is just selecting high quality stocks. The low volatility portfolio is only selecting low volatility stocks. And then you blend or mix those independent factor strategies together to create a multi-factor strategy. An alternative approach is to say, let's create a portfolio of stocks that have characteristics across all of the factors. We just don't want cheap stocks. We want cheap stocks that are also high quality, that are also low volatility, that have positive momentum. Well, you can use a composite score to create something like that. This is just standard practice in active quantitative management. We've studied thoroughly when and why one approach is superior to the other. If you are creating a high concentration, low capacity, high turnover active strategy, you're far better off integrating, creating a composite score across not just these half dozen factors, but maybe dozens of other factors as well. And that really gets to active management. Much lower capacity tend to be higher fees, and that's appropriate in that context. However, there's a trade-off and a transition when you're talking about a portfolio that's designed to be much higher capacity, to be much more broadly diversified, to have much lower implementation cost. It turns out that mixing independent factor portfolios is actually superior, not just in terms of transaction cost, which would be obvious, but also in giving you consistent factor exposures and delivering those excess returns. So again, to repeat, For a highly concentrated, high turnover, high cost portfolio, you want to integrate the factors. For a broadly diversified factor portfolio with low turnover and low cost, you get superior results by mixing independent factors.
And I would imagine also some transparency benefits with the mixed approach.
Yes, it's much easier to do performance attribution, which can be a distinct advantage for an advisor explaining to a client what's going on and why, so they have the ability to stick with the strategy.
We've got time for a couple more questions. Next up, we have what's the largest risk for factor investing in general? And how does a multi-factor approach mitigate this risk, or does a multi-factor approach mitigate this risk?
Well, at the risk of repeating, I think the biggest risk to factor investing is performance chasing. And multi-factor investing, by diversifying across factors that perform in different cycles, is the best way to mitigate that risk. However, it doesn't completely mitigate the risk. There will be cycles of underperformance and outperformance, even for these diversified multi-factor strategies. And there, I think it's just discipline, patience, and client service that makes the difference.
We received a question from someone that's noticed that we have effectively a global suite of these multi-factor index strategies available. And the question is, we've covered a lot of U.S. results. Do the results look similar outside the U.S.? Do they look better, worse? How do the results in developed international markets and emerging markets compare to what we see in the United States?
When we study factors and determine whether a factor is robust or not, whether we believe that it will provide persistent future excess returns, a very important test is going out of sample. Now, one way to go out of sample is to break your historical period up into sub-periods and see if over sub-periods you get the same results. But another important out of sample test is to go to different geographies. We would love to have hundreds of different geographies to test, but the data is just not that high quality. I tend to focus a lot on two other markets beyond the US, the UK and Japan, because they are large, well-diversified markets with very long history. And all of these factors work in the UK as well as the US. Japan can have some different results from time to time. It's a great market to test. But we do, and when I say we here, I don't just mean the researchers at research affiliates. The academic community, the quantitative practitioners have examined thoroughly all of these key factors across the broad range of geographies and generally found that they are robust. So yes, you can pursue a multi-factor investment strategy in the US, globally, and in emerging markets.
So the factors that we're employing, we've identified as being robust across markets. I'm going to go out on a limb and guess that you spend a lot of time on performance chasing in the U.S. I'm going to go out on a limb and guess that performance chasing doesn't work outside of the U.S. either. Is that correct?
No, human nature seems to operate the same regardless of culture or geography.
Great. Thanks, Chris. That's going to wrap up our Q&A. We're out of time, unfortunately. We want to thank everyone that has taken the time to listen and submit questions this morning. As I mentioned, we'll follow up with everyone that did send in a question. A few final logistical notes. A replay of this webinar will be available on researchaffiliates.com by this afternoon. If you're on our mailing list, you'll be notified when the replay is posted. If you have not subscribed, you can do so on our website. Finally, we have a 1-minute survey that will appear on your screen after we conclude. We very much value your feedback, and we hope you can take a moment to share your impressions of today's webinar, provide feedback, and suggestions as to how we can make these more useful in the future. Thank you again for taking the time to join us this morning.